June 2008. Two portfolio managers, same city, same credentials, both managing roughly $400 million. The first one, David Chen, had just finished rebalancing his fund, 93% equities, financial stocks overweight. His quarterly report showed 14% returns year to date. His investors were pleased. His bonus was tracking toward $2.7 million. The second one, Patricia Orozco, had done something different in the previous 90 days. She'd rotated 61% of her portfolio into instruments most of her peers weren't even looking at. Her quarterly report showed flat returns, zero growth. Her investors were asking questions. Some were threatening to pull capital. 90 days later, on September 15th, Lehman Brothers filed for bankruptcy. Chen's fund lost 38% of its value in 14 trading days. By year-end, it was down 52%. He was terminated in November. Orozco's fund lost 4%. By December, she was up 11% for the year. Her assets under management doubled in 2009. Same market, same collapse, two entirely different outcomes. The difference wasn't luck. It wasn't insider information. It was something else. What happened here was not random, and it wasn't isolated to 2008. If you go back through every major financial collapse in modern history, you find the same pattern, a specific window, roughly 60 to 120 days before the system breaks, and in that window, a small group of investors makes a coordinated shift. They don't just sell, they buy. But what they buy is invisible to most people watching markets. It doesn't show up in headlines. It doesn't trend on financial news. Most retail investors never even know it's happening. I call it the Crisis Liquidity Ladder. Here's what it is. In the final phase before a financial system collapse, there's a hidden transfer occurring. It's not wealth destruction, it's wealth repositioning. Smart capital doesn't flee the market entirely, it climbs a ladder. From high volatility, high correlation assets to low volatility, negative correlation instruments. And here's what most people miss. The ladder has rungs, specific asset classes that perform specific functions during the transfer. The people who understand this ladder don't panic when markets break. They prepare 90 days before. They climb methodically. And when everyone else is watching their portfolios collapse, these investors are either protected or profiting. This isn't theory, this is pattern, and the pattern repeats with statistical precision. The Crisis Liquidity Ladder has 5 rungs. Each one serves a different function. Rung 1, information divergence. This is where it starts. Somewhere between 6 and 4 months before a collapse, you begin seeing divergence. Market prices are still rising, but certain data points stop correlating. Credit default swaps start pricing differently than equity valuations. Volatility indices show suppression that doesn't match actual risk distribution. In early 2008, the VIX, the volatility index, was trading at historic lows, around 17. Meanwhile, the credit markets were showing severe stress. The TED spread, which measures stress in lending markets, had jumped from 50 basis points to over 200. The smart money notices this first. Not because they're smarter, because they're watching different indicators. While most investors track stock prices and earnings reports, crisis-aware investors track correlation breakdowns. What they do, they begin reducing exposure to high-beta cyclical positions, not aggressively, methodically. They start trimming financial sector overweight. They reduce leverage. They build cash positions. This doesn't show up in performance yet. In fact, in the short term, they underperform. Their peers think they're being overly cautious. Rung 2, the first repositioning. 60 to 90 days before collapse, the repositioning accelerates. This is where the real transfer begins. They don't just sell equities. They rotate into the first hedge, uncorrelated safe havens. In 2008, this meant 3 things. First, U.S. Treasury bonds, specifically longer duration bonds. Between April and June 2008, while the S&P 500 was still trading near 1,400, sophisticated investors were accumulating 10-year and 30-year treasuries. The yield on the 10-year dropped from 3.7% to 3.9%, even as inflation concerns dominated headlines. This made no sense to conventional analysis. Inflation should push Treasury prices down, yields up. But crisis-aware investors weren't buying Treasuries for yield. They were buying them for what comes next. Second, gold, not gold mining stocks, physical gold exposure. Between March and June 2008, gold prices dropped from $1,000 per ounce to around $870. Most investors saw this as a failed rally. Crisis-aware investors saw it as a discount window. They accumulated. Third, put options, not speculative bets, structured downside protection. They were buying far out of the money puts on financial sector ETFs and broad market indices. These were cheap, extremely cheap, because the market still believed the risk was contained. What most people miss, this looks like a losing position. In June 2008, all three of these positions were underperforming. Treasuries were flat, gold was down, put options were decaying. Conventional performance metrics said these investors were wrong, but they weren't measuring performance on a quarterly basis anymore. They were measuring survivability on a 12-month basis. Rung 3, volatility preparation. 30 to 60 days before collapse, the preparation shifts from defense to strategic positioning. This is where it gets important. The crisis liquidity ladder isn't just about protection, it's about transfer. When a system collapses, liquidity doesn't disappear, it concentrates. And the investors who position for this concentration don't just survive, they acquire. In July and August 2008, while markets were still trading in a range, sophisticated funds were doing something specific. They were establishing dual positions. On one side, maximum downside protection through puts and inverse instruments. On the other side, they were preparing cash deployment structures, lines of credit, dry powder, not to deploy immediately, but to deploy when forced liquidation created mispricing. The data shows something fascinating here. In August 2008, institutional cash positions hit a 12-year high, not because institutions were panicking, because a subset of institutions were preparing for the transfer. Rung 4, the break point. This is when the system fractures. For 2008, this was September. Lehman, AIG, Washington Mutual, the cascade. Most investors experience this as chaos, positions liquidating, margin calls, forced selling. But for the investors who climb the ladder, this is execution. Their treasury positions surge. Between September 1st and September 30th, 2008, the 10-year Treasury yield collapsed from 3.8% to 2.4%, a move that translated to roughly 15 to 20% gains on long-duration bonds. Their gold positions stabilize, then rally. Gold went from $830 in September to over $1,000 by February 2009. Their put options, these exploded. Far out of the money puts that cost pennies in June were worth dollars in September, 100 to 1 payoffs, 1,000 to 1 in some cases. But here's what separates the prepared from the lucky. They don't just hold these winning positions, they rotate again. Rung 5, the acquisition phase. This is the final rung, the one nobody talks about. Between October 2008 and March 2009, while the market was in freefall, the investors who had climbed the ladder were doing something counterintuitive. They were buying equities again. Not the same equities they sold, not at the same valuations. They were buying forced liquidations at 30, 40, 50 cents on the dollar. In March 2009, the S&P 500 hit 666. Blue-chip companies were trading at single-digit price-to-earnings ratios. Investment-grade corporate bonds were yielding 12 to 15%. Real estate assets were selling for fractions of replacement cost. The crisis liquidity ladder delivered them to this moment with three things. 1. Capital preserved. 2. Downside positions that had generated cash. 3. Dry powder ready to deploy. This is where the real transfer happened. Not in the collapse, in the acquisition. This pattern isn't unique to 2008. It repeats. And the repetition is what makes it a system, not an accident. 1929. 90 days before the October crash between July and September, there was a specific group of investors doing something unusual. They were rotating out of margin-heavy equity positions into cash and government securities. Joseph Kennedy, Sr. is the famous example. But he wasn't alone. A subset of institutional investors had begun reducing exposure in August, not because they predicted the exact date, because they saw the same divergence, credit tightening while stock valuations expanded, margin debt at record levels while earnings growth slowed. The investors who made this rotation didn't just survive the crash. By 1932, they were acquiring assets at 10 to 15% of peak valuations. Some of the greatest fortunes of the 20th century were built in that acquisition phase. 1987. The 1987 crash was faster, more violent. The market dropped 22.6% in a single day, October 19th. But 90 days before, in July 1987, there was the same signal. Portfolio insurance strategies were creating hidden leverage in the system. The smart money wasn't predicting a one-day crash. They were seeing structural fragility. Between July and September, institutional cash positions increased, not dramatically, but measurably. The investors who held higher cash positions didn't avoid the crash, but they suffered 8 to 12% drawdowns instead of 22%. And they had capital to deploy in November when stocks were down 30% from peak. 2000. The dot-com bubble took longer to collapse. It wasn't a single event. It was a rolling collapse from March 2000 to October 2002. But 90 days before the peak in December 1999 and January 2000, there was a rotation. Not publicized, not headline-making, but measurable. Certain hedge funds and family offices began reducing exposure to high-flying technology stocks. They rotated into value equities, treasuries, and cash. Their performance reports from Q1 2000 showed underperformance. They were questioned by investors. By Q4 2001, those same funds were outperforming by 40 to 60 percentage points. 2020. This one is more recent, more observable. 90 days before the COVID crash in March. 2020 would put us in December 2019. The virus hadn't made international news yet. Markets were at all-time highs. The S&P 500 crossed 3,200. But something was happening in credit markets. Repo market stress in September 2019 had forced the Federal Reserve to inject liquidity. By December, certain institutional investors were seeing divergence again. Equity valuations at historic highs while credit markets required ongoing central bank intervention. The investors who began rotating in January and February 2020, before the crash, didn't know about a pandemic. They knew about structural fragility. They climbed the ladder. Treasuries, gold, cash positions, pots. When March hit, these positions worked exactly as designed, and by April they were deploying into the fastest market recovery in history. Right now, in 2025, the same structural elements exist, not identical to 2008, not identical to any previous collapse, but structurally similar. We're seeing divergence again. Equity markets at historic valuations while certain stress indicators show elevation. The VIX suppression despite geopolitical risk. Credit spreads compress despite rising default rates in commercial real estate. This doesn't mean collapse is imminent. That's not how the Crisis Liquidity Ladder works. The ladder appears before we know the exact catalyst, sometimes months before. What it means is this: if you understand the pattern, you're watching different indicators than most investors. You're not trying to predict when, you're preparing for if. The investors who understand this aren't making bets, they're making rotations, methodically, without emotion, not because they're bearish, because they're systematic. If you want to track this pattern yourself, there are 4 measurable indicators. These aren't predictions, they're divergence signals. Signal 1, credit equity divergence. Watch the relationship between investment-grade corporate bond spreads and equity valuations. When stock prices rise but credit spreads widen, That's divergence. It means the credit market is pricing more risk than the equity market. Historically, credit markets lead, equities follow. You can track this through the CDX investment grade index. When it rises while the S&P 500 rises, that's correlation. When it rises while the S&P 500 also rises but at different rates, that's early divergence. Signal 2, volatility suppression. The VIX trading below 15 while realized volatility in sector rotations exceeds 20% is a structural warning. It means volatility is being suppressed through derivatives and structured products, not eliminated. That suppression eventually breaks. Signal 3, institutional cash builds. Track the Federal Reserve's H.8 data release, commercial bank cash assets, and institutional money market fund inflows. When these rise consistently for 3 consecutive months during a bull market, it signals rotation is beginning. Signal 4, gold treasury correlation shift. Normally, gold and treasuries move inversely during growth periods. When they start moving together, both rising, it signals a flight to safety is beginning beneath the surface, not panic, preparation. Back to June 2008. David Chen and Patricia Orozco weren't different because of intelligence. They were different because of framework. Chen was optimizing for quarterly performance. He was watching stock prices, earnings reports, and relative performance metrics. All of his indicators said the market was recovering from the 2007 subprime stress. Financials were cheap. The rebound trade looked strong. He was managing to the wrong measurement system. Orozco was watching divergence. She saw credit markets breaking while equity markets rallied. She saw the TED spread widening while the VIX compressed. She didn't know Lehman would fail in September. She didn't need to. She climbed the ladder. Treasuries, gold exposure, puts, cash builds. When the system broke, her framework delivered survival, then acquisition. Chen's framework delivered destruction. Same information, different systems, different outcomes. The Crisis Liquidity Ladder isn't about predicting crashes. It's about understanding transfer. Financial collapses don't destroy wealth. They relocate it, from the unprepared to the prepared, from the reactive to the systematic, from those optimizing for short-term performance to those optimizing for long-term survivability. The pattern has repeated for a century. It will repeat again. Not because markets are rigged, because human behavior in systems is predictable. Leverage builds, divergence appears, fragility increases, something breaks, transfer occurs. The investors who understand this don't time the market. They don't predict the catalyst. They watch the signals. They climb methodically. They prepare for transfer. Most investors will never do this, not because they can't, because they're measuring the wrong things. They're optimizing for quarterly returns in a system that transfers wealth over multi-year cycles. This is the difference between playing the game and understanding the game. If this gave you a new framework for thinking about market cycles and capital preservation, the next step isn't to make any immediate changes. It's to start watching the signals, track the divergences, understand the pattern, because the ladder will appear again. And when it does, the question isn't whether you'll see it. The question is whether you'll climb it.